Welcome, curious minds, to another deep dive. Today, we're going to take a look at a company that's really, well, it's become a household name, hasn't it?
Absolutely. Transforming how we get, well, almost everything delivered.
We're talking DoorDash, and we've gotten our hands on their latest quarterly report, the Form 10Q, for the period ended June 30, 2025. Now, you know these documents. They can be incredibly dense.
Oh, yeah. Packed with financial jargon, legal stuff.
But our mission today is to, cut through all that. We want to pull out the important nuggets, see what the story is behind the numbers.
Right. And for you, we've distilled the key data points, the strategic insights from this filing. We'll unpack their recent financial performance, some pretty significant strategic moves, too.
Like acquisitions?
Big ones. And financing, plus the critical risks and the challenges they're navigating. What's really fascinating here, I think, is how they're balancing this rapid growth with all the complexities of, well, a very dynamic regulatory environment.
Okay, so what does this all mean for a company like DoorDash? Let's unpack this. All right, let's kick things off with the financials. Because, honestly, they tell a really compelling turnaround story for Q2 2025.
They really do.
Revenue hit, what, $3.284 billion?
Yeah, that's a big jump from Q2 last year, $2.630 billion then.
So it's a 24.8% increase. Strong top-line growth, no question.
Definitely. But perhaps the most interesting nugget here is that remarkable swing from an operating loss to operating income.
That really caught my eye, too.
In Q2 2024, they had a loss of $201 million from operations.
Right.
But Q2 2025, they posted operating income of $163 million.
Wow. That's not just a small improvement. That's a major reversal.
It absolutely is, and it flows right down to the bottom line.
Net income attributable to stockholders.
Exactly. That reached $285 million in Q2 2025.
Compared to a net loss of $157 million the year before.
Quite the turnaround.
It really is. I mean, growth is one thing, but profitability in this delivery space, that's tough. What were the underlying operational things that allowed this? Was it just more orders?
Well, more orders definitely helped. Total orders grew 20%, reaching 761 million in the quarter, driven mostly by more consumers and, higher engagement. But crucially, their net revenue margin also ticked up.
Ah, okay. So revenue as a percentage of the total value of orders.
Precisely. It went from 13.3% to 13.5%.
Doesn't sound like much, but on huge volumes.
Exactly. And the report links this improvement to better logistics efficiency.
Makes sense.
Growing advertising revenue on their platform, which is interesting.
Right, selling ad space to restaurants.
And fewer credits and refunds they had to give out relative to the order value. And that's despite a shift towards some categories that usually have lower margins, like, say, groceries.
So it's got a double win. More orders, and they're making a bit more on each order, on average.
That's a good way to put it.
Yeah.
Better efficiency.
And this efficiency, it's clearly showing up in their adjusted EBITDA. Right. That's a number people watch closely.
Absolutely. That non-GAAP measure saw substantial growth, too. It increased to $655 million in Q2 2025.
Up from $430 million in Q2 2024.
Yeah, a big jump. And the report says it was driven by growth in what they call contribution profit.
Okay, contribution profit. Can you break that down a bit? What does that actually mean?
Sure. Think of it simply as the revenue left over from each order after you cover the direct variable costs.
Like paying the dasher?
Exactly. Dasher pay, refunds, payment processing fees, that sort of thing.
So seeing that grow means the core transaction is getting healthier.
Precisely. It signals they're getting more efficient and profitable at the very heart of the delivery business, the individual order. And that operational strength, well, it translates directly into their overall financial flexibility.
Which seems pretty strong. Looking at liquidity, as of June 30, they reported $5.7 billion in cash, cash equivalents, and marketable securities. Yeah, and $3.9 billion of that is just cash and cash equivalents. That's a solid war chest.
Definitely gives them options.
But here's something interesting I noticed. Back in February 2025, they authorized a $5 billion share repurchase program. Huge amount.
Right, I saw that too.
Yet the report says no shares were actually repurchased in the first 6 months of 2025. What do you make of that? Are they being picky about the stock price, or maybe saving that firepower for something else?
That's a very insightful question. It could be strategic discretion, waiting for better market conditions, or it could absolutely mean they were prioritizing capital for other strategic initiatives.
Like maybe acquisitions?
Exactly. Which brings us perfectly to their big strategic plays.
Yeah, perfect segue. Let's talk strategy. The biggest news has to be the Deliveroo deal.
Oh, absolutely. Massive news.
Announced May 6th, 2025. A recommended final cash offer to acquire Deliveroo Pack.
For around £2.8 billion, that's about 180 pence per share.
A huge move onto the global stage for DoorDash. What's the strategic thinking there? Just buying customers.
Well, yes, but it's much more than that. Deliveroo has a really strong presence in Europe and the Middle East.
Areas where DoorDash isn't as dominant, right?
Exactly. It complements their existing geographical footprint really well. It lets them challenge competitors like Uber Eats directly in those key markets.
So it's about securing future growth internationally.
Precisely. And navigating different regulatory environments, too.
And the deal status.
Deliveroo shareholders approved it on June 16th. They expect it to close in Q4 2025, assuming regulatory approvals come through.
Okay. And to handle the currency risk, paying in British pounds, they did something called a deal contingent forward contract.
Yeah, for the full $2.8 billion amount, it's basically a hedge.
A hedge, like insurance against the exchange rate moving badly.
Sort of, yeah. Think of it like locking in an exchange rate for a future purchase, but only if the purchase actually happens.
Okay, so it protects them if the pound strengthens against the dollar before they pay.
Exactly. Makes the final cost more predictable. And interestingly, because of currency movements, this derivative actually resulted in an unrealized gain of $69 million in Q2.
Recorded as other income.
Clever.
It's sophisticated financial management.
And how are they funding this massive deal?
Well, they put $2.5 billion cash into an escrow account already.
Okay.
And they also lined up a bridge term loan agreement for up to $2.85 billion, just in case, though they hadn't drawn on it as of June 30th.
So, keeping their options open on the final funding mix.
Seems like it. Very flexible approach.
All right, so Deliveroo is the big one, but they also did some interesting financing stuff, right? These convertible senior notes.
Yes, in May 2025, they issued $2.75 billion worth of 0% convertible senior notes due in 2030.
0% interest. That sounds amazing.
It's very attractive debt financing. Net proceeds were about $2.72 billion after cost.
And convertible means?
It means holders can convert the notes into DoorDash Class A common stock, but only if the stock price goes above a certain level.
About $291.97 per share initially. If it converts, they pay the principal in cash, and anything above that value can be paid in cash or shares at DoorDash's option.
Okay. And had that price condition been met yet?
Not as of June 30th, no. But interestingly, the fair value of these notes was already $3 billion by then.
Trading above their principal amount already. What does that signal?
It generally signals strong investor confidence. The market sees value in that conversion option.
Anticipating future stock growth.
Got it. And alongside these notes, they did some other complex things, note hedges and warrant transactions.
Right. This is another layer of sophisticated capital management.
For those hedges, they also sold warrants for $341 million.
Warrants? Like options?
Similar, yeah. These warrants give the holders the right to buy DoorDash stock in the future, but at a much higher price. The strike price is $512.225 per share.
Whoa, way higher than the convertible note threshold.
Exactly. So these warrants would only become dilutive if the stock price really, really takes off.
So the net cost of this hedge and warrant combo was about $339 million, recorded against paid-in capital.
Correct.
Okay, let me try and simplify this. They borrowed money at 0%. Then they bought insurance, the hedge, so they don't have to issue too many shares if the stock pops. And they paid for part of that insurance by selling lottery tickets, the warrants, that only pay out if the stock really skyrockets.
That's actually a pretty good analogy, yes. It's a way to get cheap financing while proactively managing potential future dilution. Very savvy.
It does sound quite advanced. And just quickly, there was another smaller acquisition mentioned in Q1.
Yeah, about $28 million for another company. The report notes $21 million of that was booked as goodwill.
Goodwill meaning the value beyond tangible assets, like brand, tech, people.
Exactly. It represents the premium paid for those intangible assets that aren't easily itemized on a balance sheet, but are expected to contribute to future earnings. Shows they're still making smaller, targeted bets, too.
Okay, so the picture so far. Solid growth, this big swing to profitability, huge strategic plays like Deliveroo, clever financing. It sounds pretty positive.
The numbers certainly look strong for the quarter.
But as the 10Q itself keeps saying, these forward-looking statements, they come with big risks and uncertainties.
Absolutely critical to remember. They operate in a very competitive, very fast-changing world.
So what are the major headwinds, the big challenges they're highlighting? What keeps them up at night?
Well, probably the biggest one, the most fundamental one, revolves around the classification of their workers.
The Dashers. Independent contractors versus employees.
Exactly. This is an ongoing battle. They face lawsuits, arbitration, regulatory probes, all challenging that independent contractor status.
And they mentioned a specific example in California, right? The EDD assessment.
Yes, the California Employment Development Department. In January 2023, they hit DoorDash with an assessment for payroll tax liabilities. The CAEDD is basically saying Dashers there should be classified as employees.
How's DoorDash responding?
They state very clearly they believe Dashers are properly classified as independent contractors, and they're vigorously appealing that assessment.
But the potential impact, if they lose that appeal or if this classification changes more broadly.
It could be significant. We're talking potential monetary exposure for things like unpaid wages, benefits, back taxes, penalties.
And maybe more fundamentally,
It could force fundamental changes to their business model, their entire operational structure, their cost base.
that feels like a huge question hanging over not just DoorDash, but the whole gig economy, really.
Yeah.
How sustainable is this model long-term with evolving labor laws?
It's the critical question, I think. If Dashers were reclassified, the immediate impact on operations, on costs, it would be massive. Whether the model breaks or just fundamentally reshapes itself is the multi-billion-dollar question.
Definitely something to watch. What other risks stand out?
Well, beyond worker classification, there's the broader legal and regulatory landscape.
Like consumer protection stuff.
Yeah.
Pricing, fees, tips.
Yep. Legal proceedings around all of that, plus disputes over listing restaurants they don't partner with sometimes.
And data privacy, cybersecurity, always huge for a tech platform.
Especially operating globally. You've got GDPR in Europe, various U.S. state laws. Breaches or noncompliance could mean big fines, lawsuits, reputational damage.
They even specifically mentioned AI risks in the report.
They did. Things like data leakage, ethical concerns. It hints that they see future regulatory challenges coming down the pike specifically related to AI.
And new regulations are already biting, right?
Yes. The EU is enacting new laws for digital services and AI. That means higher compliance costs. And closer to home, things like minimum earnings standards for delivery workers, if they cite the New York City rule from December 2023, and price control measures in some places. These are increasing operating costs.
Which might force them to charge consumers more.
Potentially, yes. Which could then impact demand. It's a tricky balance.
So regulatory pressure from multiple angles.
Yeah.
And then there's just plain old intense competition.
Oh, yeah. The market is incredibly crowded. Lots of well-capitalized players out there.
Offering discounts, lower fees, trying new things.
All that pressure can force DoorDash to adjust its own commission rates or fees or incentives for Dashers and consumers, which of course can hit their financial performance.
And their whole model relies on that network effect, right? Attracting and keeping merchants, consumers, and Dashers.
Absolutely crucial. They need to attract and retain all three sides of that marketplace cost-effectively. If they can't offer compelling opportunities for Dashers or good selection and pricing for consumers, that virtuous cycle could weaken.
And operationally, just keeping the platform running smoothly.
That's a risk too. System failures, the need for constant innovation just to keep up technologically, and maintaining a cost-effective platform, things like Dasher efficiency, managing pay, minimizing messed up orders, it's a constant optimization challenge.
Seems like a lot of moving parts to manage.
It really is.
Anything else major? Governance? Economic factors?
Well, from a governance perspective, the report does point out the multi-class stock structure. Voting power is highly concentrated with the co-founders, especially Tony Zhu, meaning other stockholders have limited influence on major decisions. It could potentially delay or even prevent a takeover, even one that other shareholders might see as beneficial.
Okay, something for investors to be aware of.
And finally, just the big picture, broader economic conditions, inflation, interest rates, geopolitical issues.
Yeah, those can always impact consumer spending on things like food delivery.
Exactly. Adverse conditions could definitely put a damper on the business. It's a complex web of external factors.
All right, so pulling it all together, what's the main story you take away from this deep dive into DoorDash's Q2 2025.
What's really fascinating here is this clear narrative. You see a company hitting major financial milestones, especially that big swing to profitability. And at the same time, they're executing these large, complex, strategic moves, the Deliveroo deal, the sophisticated financing. It really demonstrates a remarkably advanced approach to managing their capital, using cash, debt, equity instruments very deliberately.
Absolutely. It really does feel like watching a tightrope walker, doesn't it?
That's a good image.
They're balancing this impressive growth, these aggressive expansion plans, with this constantly shifting regulatory landscape and all the inherent risks of, well, a pretty new industry.
Making big moves while navigating big challenges.
Especially that core issue around Dasher classification, that seems central.
It really does. And it raises this crucial question, maybe something for you, the listener, to think about. As this whole gig economy matures, how will companies like DoorDash keep innovating and growing? Especially when they're facing this increasing pressure from evolving labor laws and also from consumers about pricing and worker compensation.
Yeah, how might this shape the future of these on-demand services for all of us?
It's a huge question.
Exactly. It's definitely a dynamic puzzle. A lot of moving pieces. Well, that's all the time we have for this deep dive. We hope you feel a bit more informed and maybe a little more curious about the complex, always changing world of modern commerce.